On the 29th of April 2025, the UK government, and Treasury to be precise, released its new draft crypto regulation that it intends to consult on over the next month or so before making this policy, probably in 2026. So in this video, we'll be looking at exactly what's covered in this proposed legislation, what the changes might mean for crypto investors and firms in the UK, and if this is an improvement from what we've seen previously. So please do like the video and subscribe to the channel so I can continue to offer more content for you in future. If you follow our social media channels on X, Facebook and Instagram, you'll receive daily crypto and financial education news update posts which will keep you informed. Stick around to the end of this video to find out what services Coin Knowledge offers. Just a quick reminder that nothing contained here is financial advice, and let's jump straight in. Treasury published its draft SI, or statutory instrument, on the 29th of April, called the Financial Services and Markets Act 2000, Regulated Activities and Miscellaneous Provisions Crypto Assets Order 2025, with mention of crypto assets here in brackets. And I'll include links to everything discussed in this video in the description if you wanted to check them out for yourself. And this order is to essentially enable or give power to the FCA, as well as the PRA, which is the Prudential Regulation Authority and is part of the Bank of England, to oversee and set new rules for crypto investors and firms in the UK, with the FCA confirming this on their website, stating that this new crypto regulation goes further than the previous money laundering, terrorist financing and transfer of funds regulations and financial promotions regime that we've had in the UK to become a more comprehensive crypto regime. Because all the way back in October 2023, under the previous Conservative government, Treasury published its proposals for creating a new UK financial services regulatory regime for crypto assets. So this crypto regulation has been a long time in the making, and its overall aim is to integrate cryptocurrencies and related activities into the existing UK financial services regulatory framework by aligning them with securities regulation rather than them being set outside on the periphery. And this now includes new regulation on crypto services in the UK, such as stablecoins, operating a crypto trading exchange or platform, staking, dealing or arranging deals in cryptocurrencies, safeguarding or custody of crypto assets, as well as market abuse and admissions and disclosures, which aren't actually included specifically in this draft crypto legislation and will be shared at a later stage. And I'll also be mentioning crypto lending and DeFi in this video to see what Treasury say about these. It's important to state at this point that this is a draft regulation at this stage, with there being a deadline to send what the Treasury is calling technical comments on this draft by the 23rd of May 2025, so not that long. And I know that the UK crypto associations, like Crypto UK for example, are preparing to send their own comments along with their members, with you being able to see here how to do this, according to Treasury's policy note. And the FCA also released an 83-page discussion paper on regulating crypto asset activities on the 2nd of May, asking for views on its approach to regulating crypto trading platforms, intermediaries, crypto lending and borrowing, staking, decentralized finance, and the use of credit to purchase crypto assets, which we'll be coming back to again in this video. And the FCA wants responses to its discussion paper by the 13th of June, with us then having to wait to see more details, given that this is just a draft currently. But let's now jump into the detail that we've got and start with what the UK government defines a crypto asset as in this new regulation. Because to be a crypto asset, it has to be fungible, so it can be replaced or exchanged with another one which is the same. So for example, one Bitcoin is one Bitcoin, regardless of which Bitcoin of the 21 million it is, as opposed to something which is non-fungible, so is essentially unique, like a piece of art, a house perhaps, or most famously, an NFT. Also, a crypto asset has to be transferable, with there unsurprisingly being no mention of a crypto asset being decentralized here. All cryptocurrency exchanges or trading platforms, dealers, and agents that provide crypto services to UK residents have to be regulated with the FCA, regardless of whether the firm is based in the UK or overseas. The only providers that don't need to register are foreign crypto entities that only engage with institutions rather than retail investors, provided that these institutions aren't acting as intermediaries to UK retail investors, so basically no retail. and you shouldn't expect crypto firms that operate outside of the UK regulatory framework to offer any crypto services to retail investors, as is the case currently, frustratingly. But an overseas crypto firm could likely offer services to UK retail crypto investors if it can find an intermediary that's registered with the FCA in the UK to offer crypto services to retail investors. UK-based crypto exchanges or trading firms will have to conform to the FCA's operational standards that are aimed at enhancing market integrity and consumer protection, and which are contained in its discussion paper. And there are 6 key areas here currently, including market abuse monitoring, so the platform having systems to detect and report market manipulation and insider trading, transparency in terms of the order book and historical trade data being displayed publicly, operational resilience, so having robust systems to prevent outages, cyber threats, and ensure trades are settled quickly. The 4th area is around fair trading rules, which involves having preset rules for trading on the platform that are followed for all users, rather than the platform being able to use its judgment to match trades. The FCA will also look at how platforms manage conflicts of interest. For example, it's looking to ban platform operators and potentially affiliates from trading on their own platforms due to the risks of unfair advantages. And finally, the FCA is looking at algorithmic and automated trading, so bot trading, with the FCA not detailing anything here yet, but saying it is looking into this in terms of how best to regulate it, particularly when looking at any retail crypto investors who use them. So this is one to keep an eye out for when more detail is published. And please do have your say and submit your views to HM Treasury and the FCA. HM Treasury will also require the FCA to set a period of time before the new crypto regulations come into force, in which firms can submit early applications to the FCA to be considered, and then make any amendments needed if they want to before the rules are implemented, because the FCA will have the power to order any UK businesses that don't meet these requirements to wind down their operations in the UK over a maximum 2-year period. But that will give crypto firms up to 2 years to adjust their systems and become registered with the FCA. But let's move on now and take a look at what the UK is doing with stablecoins, because the aim is to now regulate stablecoins because they currently sit outside of the regulated financial system. HM Treasury defines a stablecoin as referencing one or more fiat currencies, so pounds, dollars, euros, etc., and seeks to hold those fiat currencies as backing assets to maintain a stable value. Importantly, they don't consider stablecoins as electronic money or e-money, but as securities, because they want to maintain oversight of them and ensure adequate redemption protocols and that the underlying assets are actually there. So UK stablecoin issuers would be more restricted in the sense that they couldn't just mint new stablecoins. They'd have to follow the rule set, for example, being specifically backed 1-to-1 by the fiat currency, which would reduce risks such as the stablecoin depegging, for example, but with some saying that excluding stablecoins from the e-money regulations and not seeing them as essentially digital money could slow their use for payment and adoption. Stablecoins are exempted from being a collective investment scheme, so they will avoid the specific rules and requirements involved with these. Stablecoins and their backing assets also won't fall under the Alternative Investment Fund Managers regulations. And as part of this new regulation, in some pretty big news, the UK will exempt overseas stablecoin issuers who want to sell to British investors from having to comply with its new crypto rules. So think about firms like Tether, which has already been legitimised in the UK courts and described as property with legal protections, Circle's USDC, etc. Only stablecoin issuers based in the UK would need FCA regulatory approval. So this is the Treasury saying that it's trying to strike the balance between protecting consumers and also being an attractive place for crypto activities in the UK. But let's now look at staking and what the new draft UK crypto regulations state about this, because this is also an area that's being brought into the regulatory framework. So any exchange or crypto firm wanting to offer staking services to UK customers will need FCA authorization. And the FCA sees some risks involved with staking and some solutions to reduce these. So starting with the risks, the FCA states that slashing can occur to penalise bad validators, and risks from relying on other providers for validator nodes. There could also be safeguarding risks with client assets, possibly mixed with firm assets or other client assets, or poor record keeping and reconciliation, which could lead to shortfalls or the company not returning the correct assets to the customer. There could also be misleading marketing, where the company highlights the yield without explaining the underlying process, any lockup periods, fees, etc., and a lack of consent, where some firms stake customer assets without their explicit consent. So the FCA proposes 6 requirements as part of this new regulation for staking. Firstly, explicit consumer consent for the amount staked, terms, fees, etc. Secondly, the firm must share a key features document outlining the risks, fees, lockup periods, reward structures, and ownership status. Thirdly, there must be separate wallets for consumers' staked assets, so a segregation of staked assets. Fourth, there must be accurate record keeping and regular reconciliations. Firms must also manage technological risks that are identified in the risks section, and they may be liable for losses if they haven't managed those risks adequately. And finally, firms should hold enough capital to absorb any losses with things like slashing, and may be liable if they haven't adequately managed them. So given that we've just looked at staking, let's now move on and look at what these new crypto regulations state about crypto lending and borrowing, because this is a big one. And obviously, crypto platforms will again need to be regulated with the FCA if they want to offer these services to UK crypto investors, with the same caveat that I mentioned earlier when we looked at exchanges, that foreign crypto lending platforms could get around this by engaging indirectly with UK consumers by using a regulated UK trading platform or what they call a dealer instead for this. The FCA seemingly views any time you give up custody of your crypto as lending, as you can see here with the mention of yield farming. However, straight away in their discussion paper, the FCA highlights risks across crypto asset lending and borrowing, including a loss of ownership, so you potentially being in trouble if the firm becomes insolvent, liquidity, and being able to access your assets immediately, counterparty risk, with many being unregulated, overseas or decentralized, and may have little to no risk management frameworks, a lack of consumer understanding by retail investors, a conflict of interest with platform tokens, where individual crypto lending and borrowing platforms have their own token, speculative yield generation, in the sense that the yield and returns aren't fixed, with consumers typically not knowing exactly how their crypto assets are being used to generate those returns. Margin calls, so where you may become liquidated if you can't add more collateral to maintain the loan to value or LTV ratio, should the price of the collateral drop relative to the loan. And finally, credit worthiness, where individuals aren't assessed as to their ability to afford the loan, just relying on the collateral that they put down. And whereas I view this as a positive, that individuals can access lending and borrowing services if they have the assets to put down against their loan, which is what matters as it protects the lender, and consumers don't have to justify everything and go through long, tedious applications, the FCA sees this as a large risk if there's no evaluation of the consumer's broader financial situation. So their capacity to meet repayment obligations or capacity for loss, because there's more chance of default, leaving consumers susceptible to financial instability. And these risks are why the FCA is proposing a ban on crypto lending and borrowing to retail investors in the UK, and will instruct firms not to offer these products to retail investors. Institutional clients will be able to take part in crypto lending and borrowing, just not retail. But the FCA does ask for feedback on this position, as you can see here with this question. So again, please do have your say, with them stating that they are exploring alternatives to see if they can reduce the risk of crypto lending and borrowing. For example, is considering only allowing stablecoins to be used as collateral or as a loan for retail investors in the UK who want to participate in crypto lending and borrowing. They state that this would reduce the likelihood of a margin call and would stabilise interest rates, so would protect retail investors. But this is still restricting the ability of retail investors to borrow against their Bitcoin or other large cryptocurrency, for example. The FCA is also considering placing restrictions on firms or platforms' use of their own tokens for crypto lending and borrowing, due to a conflict of interest and then being able to manipulate areas, such as offering more favourable terms if you use that token as collateral or take that token out as a loan. So what's the alternative if retail investors are banned from using crypto lending and borrowing services in the UK due to these new crypto regulations? Well, DeFi, or decentralized finance, because this sits outside of this crypto regulation. So crypto activities that are decentralized won't require authorization with the UK in the FCA. However, there's a caveat about determining whether there's a sufficiently controlling party or parties that should be regulated, with this basically meaning, is there an identifiable company or individual that the FCA can get hold of and require it to register with them, or shut it down if not? But essentially, DeFi won't form part of this crypto regulation. And one of the last areas I'd like to look at as part of the UK's new draft crypto regulation is the use of credit to purchase cryptocurrencies, because a YouGov survey from August 2024 that was commissioned by the FCA found that 14% of people who invested in crypto used a credit card to do so, which is up from 6% in 2022, so it's more than doubled. The FCA highlights concerns about individuals using debt to purchase crypto, particularly if the value of the cryptocurrency drops and they were relying on its value to repay the debt. So, the FCA has confirmed that it's considering banning the use of credit to purchase cryptocurrencies. For example, the use of a credit card won't be allowed to purchase crypto. However, stablecoins are likely to be made exempt from this rule, as they're seen as being less volatile than crypto assets, which seems a bit weird if you can just use credit to purchase stablecoins and then swap these stablecoins for another cryptocurrency that you want. And on the same day that these new draft UK crypto regulations were published in the UK, the 29th of April, Treasury and Rachel Reeves, the Chancellor, put out a press release further reiterating that the aim of this new crypto regulation is to give investors confidence, protect consumers, support innovation, while cracking down on fraudsters. Rachel Reeves also revealed discussion with the United States about digital assets and wanting to work closer with them on this after a meeting with US Treasury Secretary Scott Bessent as part of talks on a wider trade deal. So it looks like the UK will be more following the approach of the US rather than the EU when it comes to crypto regulation. But it will be interesting to see if any of their pro-crypto stance rubs off at all on the UK. Rachel Reeves said about this new crypto regulation coming in that we are making Britain the best place in the world to innovate and the safest place for consumers. Robust rules around crypto will boost investor confidence, support the growth of fintech, and protect people across the UK. With her going on to say, Britain is open for business, but closed to fraud. And there are some who are already optimistic and positive over these new UK crypto regulations. Obviously, those at Treasury or the FCA. For example, the newly appointed Executive Director of Payments and Digital Finance at the FCA, David Gill, who said that it would increase confidence in the sector, supporting growth, because the crypto regime gives firms the clarity they need to safely innovate while delivering appropriate levels of market integrity and consumer protection. But also others such as the Managing Director at Ripple, Cassie Craddock, who believes that it shows clear intent from the government to position the UK as a global leader for digital assets, in which she sees Ripple benefiting as it invests in the UK, as well as the Chief Operating Officer at BitGet Exchange, who said that it's net positive for the crypto industry as it provides some clarity, especially for those firms who left the UK or didn't want to enter due to this. And the Chief Strategy Officer and Head of Global Policy at Circle, who you can see here, who's talked up these new crypto regulations in the UK and alluded to the close partnership and opportunities for the US and UK to work together on this, with them also saying that these draft crypto regulations represent a meaningful step towards embracing a rules-based digital asset economy, positioning itself as a safe harbour for responsible innovation and scaling responsible digital financial infrastructure in the UK, with him also praising Rachel Reeves and Treasury for actually getting this regulation done. So to summarise, there are some positives here, as we're eventually seeing some clarity from the UK government on crypto regulation, which should give firms more confidence understanding and clarity that they need, and therefore help to grow the crypto market in the UK. However, there are some areas that I've covered in this video that I don't agree with, because they still show too much control and oversight of crypto for retail investors in the UK, in my opinion. But we'll still have to see more detail, as it currently is only draft regulation, so please do have your say in the meantime, as there are actually 54 questions that the FCA asks in its discussion paper that you can also find at the end of the document that I've included a link to in the description of this video. We'll then need to wait for this to become policy, and then to see the details from the FCA about exactly what rules it will put into place, and then how it adopt it, and then the impact from that. For example, will areas such as on-ramping and off-ramping be made much easier, and UK investors won't be at risk of being debanked, which I'll actually be doing a video on separately in one of our next videos, so please keep an eye out for that. But that ends this video, and as always, I'd love to know what you think about the FCA, what you see happening with the new crypto regulation, about the opportunities the UK has, its shortcomings, and about its 2025 to 2026 plans that I've covered in this video. Just a reminder that if you're interested in more of a tailored approach to your crypto education, and you think you'd benefit from having someone look over your shoulder and guide you on your journey, I do offer one-to-one coaching to those who have the desire and the means to educate themselves further. And there are links in the description where you can message me and book in a free video call to see if we'd be a good fit. You can sign up for a free account with Coinly using the link in the description to this video, which is one of the best automated crypto tax platforms out there. If you're looking for more specific crypto tax advice based on your personal circumstances, I've partnered with a leading UK crypto tax company in Miner, which is part of the company Nephos, that offers other services such as wealth management, restructuring, offshoring, etc. But I'll leave a link to contact them directly in the description to this video. If you're based in the US and are looking for specific crypto tax advice based on your personal circumstances, I've partnered with a leading US crypto tax company in crypto tax audit. And again, I'll leave a link to contact them directly in the description to this video. I've also included a link to Trezor's website in the description for anyone looking for one of the best hardware wallets or cold storage out there in our opinion, with two new models in the Trezor Safe 3 and Trezor Safe 5 that I actually did a video on that you can find a link to here and in the description. And finally, if you're looking for a portfolio tracker for your crypto portfolio, that I've included a link to CoinStats in the description of this video, which is the leading crypto and Bitcoin tracker on the market. And if you found this content interesting, please do like the video and subscribe to the channel, as it really does help. And have a great day.